About 9 months ago, you said that the deal-making boom is about to hit its peak post the COVID hiatus. What does that mean where we are now? Are we past the peak?
It's always dangerous to make predictions, but I guess that one was right. I mean, last year
take a victory lap.
was a great year, I think, on all dimensions. People getting out of the pandemic, wanted to do things. Economies were firing on all cylinders. And in our industry, deal making was at record highs. We're seeing definitely a slowdown now, so I think the peak is behind us. We are seeing a little bit more headwinds as we're heading to the second half of the year.
What sort of headwinds?
Well, I think some of it is the results of last year. I mean, the economy was so strong and much stronger than the capacity. And some of the issues we're facing today, all of those disruptions in the supply chain, clearly they had external factors, but it was because demand was so strong. Now we're having, inflations and things. Clearly the war, a few hundred miles from here, especially in Europe, we feel the pain. And I feel that consumer spend is going to be under pressure. Wages are not increasing that much. Yeah. You're filling the tank in your car, it costs more, paying the bills. I think we'll feel the pinch.
Well, on the consumer point, because we have to point out you're wearing some marvelous golden goose shoes today. You've also, of course, advised Carlyle on not just that deal, but Montclair as well. What does that environment where the consumer is hesitant mean for these branded retail names?
Well, we have a view that strong brands will continue to thrive and do well over the medium term. I do believe that after the very strong 21 that we have witnessed, which actually continued at least until the first quarter of this year, because of all of this uncertainty, will probably be a little bit of a slowdown. I don't know if it's going to be a recession, but certainly the rates of growth that we have seen, I don't think it can be sustained. And what we expect to see is what we've seen in previous cycle. Stronger brands tend to do much better than the others. And so you will see a pretty big divergence in outcome depending on the strength of some of those brands.
It feels like a precarious time if we had this deal-making boom and now there are concerns about the economy. Do you see any areas of this industry of private equity that you worry about, that it feels like there are some cracks emerging?
Well, as you know, it's always easy with hindsight, but every time you overdo it, and if you listen last year, this whole investment in the tech world that I think contributed to this bubble that burst. And so, I think that is an area that still has to go through an adjustment. We've seen it in the public market. Not sure it's over, so I think we'll see. But there are certain other areas which are, I think, much more immune to those things. Think of healthcare. The fact that the population keeps aging, the fact that natality rates keep going down, that is not something that is going to change. So you'll see some sectors which probably have less of a stellar growth in the short term, but over the medium term. So that's, for example, one area. The whole energy transition is a big thing. I think it already started before, and what we're seeing with the Russian gas now only would accelerate, in my view, the trend there. So there are some trends that, in our view, will continue to be very strong.
On the point you talk about tech, and I just want to clarify here, because this is something the Amundi CEO, for example, said recently, calling some areas of private equity a bubble because there's so much money behind it. PE keeps selling to each other, valuations get inflated. Do you see the problem that acute, or is it just specific areas you're talking about?
No, I honestly don't see the problem. The reality is, it is true that there has been more and more capital raised, but also our addressable market is keep expanding. Just look at the number of private companies and public companies. There are a number of companies that prefer to remain private for longer. There are some, consequences of being public in terms of regulation, the short-term pressure. I remember in the old days, we were accused of short-termists. I have rarely seen anything more short-termist than a quarterly pressure on public companies. So the fact that private capital is getting a larger share of the market, I think it's an inevitable trend. There is still a long way to go, so I'm not concerned about that. I think it's just the market is getting bigger, and some people who operate only in the public market see their share of the pie shrinking.
Well, are you concerned, though, that the damage, the volatility we're seeing in the public market will feed into decreased and depressed valuations in private equity eventually?
Well, clearly the macro environment in general and the public market is an important benchmark. So I do believe that we will see an adjustment in valuation in the private market. There is usually a lag between the public market and the private market.
How bad do you think it would be?
Well, in certain sectors, it will be big time. We've seen the more techie exposed, where the adjustment has been pretty dramatic. If I have to say, on average, I would say one turn of EBITDA for a normal business in terms of adjustment. It's something that we expect, and this is what we are pricing in now. I mean, we are still deploying capital. I mean, we are paid to deploy capital.
We're just out of time, so I quickly want to get just where are you deploying capital in just 10 seconds? Where's the attractive area for you?
Well, as I'm mentioning, we need to deploy capital on a constant basis. Now, you do different type of things. Today, clearly, we try to position ourselves on those large, longer secular trends and less, short-term volatility. So healthcare is clearly one sector, energy transition another sector, things that have a long tailwind.